Recent data reveals a significant shift in China's economic strategy marked by a deliberate reduction in its holdings of U.S. Treasury securities alongside a concerted effort to ramp up its gold reserves. In December 2024, China's U.S. Treasury holdings fell to $759 billion, down from $759 billion, down from $768 billion the previous month, continuing a decade-long trend that has seen its investments in American debt shrink by nearly $500 billion since 2013. This strategic pivot raises critical questions about the motivations behind Beijing's moves and their implications for the global financial order. Gold, long revered as the ultimate store of value, has historically been at the center of power struggles, and today it is once again emerging as a focal point in a modern economic conflict. The world's two largest economies, the United States and China, are locked in a silent yet profound financial rivalry, with gold playing a central role in their strategies to secure economic resilience and geopolitical leverage. China's recent resurgence in gold purchases following a 6-month pause coincides with escalating tensions in the U.S.-China trade war. Since November 2024, Beijing has reportedly added tens of thousands of ounces to its reserves, a move analysts interpret as a deliberate shift away from dollar-denominated assets. This pattern mirrors China's actions between 2019 and 2020, when the Trump administration's trade policies prompted a similar flight to gold by reducing its reliance on U.S. financial instruments and bolstering its gold reserves. China appears to be insulating itself against Western economic pressures, including potential sanctions and trade restrictions. Goldman Sachs projects that global central bank demand for gold will continue to surge, potentially driving prices above $3,000 per ounce by 2026. For Beijing, gold represents more than a safe haven asset. It is a strategic shield offering stability in an increasingly fragmented and adversarial economic landscape. The U.S. dollar's dominance in global trade, particularly in commodity markets, has long afforded Washington unparalleled geopolitical influence. However, China's aggressive accumulation of gold signals a broader ambition to challenge this dollar-centric system by diversifying its reserves and encouraging other nations to follow suit. Beijing is laying the groundwork for a potential alternative financial architecture. Russia, Turkey, and India have similarly reduced their dollar exposure, suggesting a growing appetite among emerging economies to decentralize the global financial system. The Federal Reserve's interest rate policies, while strengthening the dollar, have inadvertently exacerbated U.S. borrowing costs and inflation, further incentivizing the search for non-dollar assets. Gold's historical role as a hedge against uncertainty positions it as a natural alternative, particularly as trade wars and protectionist policies amplify economic volatility. China's gold strategy carries both symbolic and practical weight. If Beijing were to back a digital currency or an international trade system with gold, it could erode the dollar's supremacy, diminishing America's ability to wield financial sanctions as a geopolitical tool. While skeptics argue that the dollar's entrenched role in global commerce makes such a shift improbable, the long-term implications of China's actions cannot be dismissed. Rising gold prices, driven in part by central bank acquisitions, reflect a growing lack of confidence in traditional financial systems. This trend underscores a broader realignment as nations seek to balance economic security against the risks of over-reliance on any single currency. Amid this U.S.-China rivalry, Canada has emerged as an unexpected player. In response to American tariffs on Canadian imports, Ottawa has proposed strengthening its supply of critical materials and energy resources to reduce Washington's dependence on China. In a bold diplomatic maneuver, Canada dispatched all 13 of its provincial and territorial leaders to Washington, positioning itself as a reliable democratic alternative to Beijing. This overture, however, has drawn sharp criticism from China, with state media condemning it as a betrayal and threatening retaliatory measures against Canadian exports. For Canada, the gamble hinges on convincing U.S. policymakers that the benefits of a closer economic partnership outweigh the costs of higher-priced imports. The outcome of this diplomatic push could reshape North American trade dynamics, offering Washington a strategic buffer against Chinese dominance in key industries. Meanwhile, Greenland has unexpectedly found itself at the center of geopolitical intrigue. Former U.S. President Donald Trump's renewed interest in purchasing the Arctic territory, a notion first floated in 2019, has sparked international controversy. Greenland, a self-governing territory under Denmark, has vehemently rejected the proposal, with widespread protests underscoring the population's preference for autonomy or independence. The Arctic's melting ice caps have unlocked new shipping routes and resource extraction opportunities, transforming the region into a strategic prize. China and Russia have both sought to expand their influence in the Arctic, investing in infrastructure and mining projects. A U.S.-controlled Greenland would grant Washington a critical foothold in this contested arena, but the proposal faces staunch opposition from Greenlandic and Danish leaders as well as geopolitical rivals. The Kremlin views U.S. ambitions in the Arctic as a direct threat to Russian interests, while China perceives it as an attempt to marginalize its growing economic footprint in the region. The convergence of these developments underscores a world in flux where economic and geopolitical tensions are redrawing the boundaries of power. China's gold accumulation, Canada's trade diplomacy, and the struggle over Greenland's future all reflect a broader contest to shape the global order. The question of whether gold can undermine the dollar's dominance remains open, but its resurgence as a strategic asset highlights the fragility of existing financial systems. Similarly, Canada's bid to replace China as a key U.S. supplier hinges on complex negotiations and competing economic priorities. Greenland's defiance, meanwhile, illustrates the growing agency of smaller states in an era of great power competition. As nations navigate this uncertain terrain, the interplay between economic strategy and geopolitical ambition will define the coming decades. Gold's resurgence signals a retreat from the neoliberal consensus that has dominated globalization, replaced by a more fragmented and mercantilist approach. Whether this shift leads to a multipolar world or reinforces existing hierarchies depends on the ability of nations to adapt to evolving challenges. What is clear is that the stakes are higher than ever with the rules of the global economy and the balance of power hanging in the balance. The answers to these questions will unfold, gradually shaped by the decisions of policymakers, the resilience of institutions, and the unpredictable forces of markets and nature. For now, observers can only speculate on the long-term consequences of China's gold strategy, Canada's diplomatic gambit, and Greenland's struggle for self-determination. What remains certain is that the world is witnessing a pivotal moment in economic history, one that will reverberate far beyond the realms of finance and trade.